GCM Grosvenor just beat Wall Street's Q2 2026 consensus expectations on both the top and bottom lines. I mean, right out of the gate, actual adjusted earnings per share came in at 19
Right,
cents.
which beats the 18-cent estimate. So that's a solid 5.56% positive surprise.
Exactly. And looking at the top line, JAP total operating revenue hit $134.34 million, which easily cleared that 131.21 million projection.
Yeah, representing a really robust 12.27% year-over-year growth, which in today's alternative asset management landscape is honestly massive.
It really is. And management didn't hold back on their forward guidance either. They're actively projecting second half fundraising to literally exceed the first half's $3.9 billion haul.
Yeah, plus they mapped out Q3 private markets advisory fees growing in the mid-single digits.
Yeah.
And they expect Q4 performance fees to hit a run rate of somewhere between $35 and $40 million.
Right. And you can see exactly how institutional capital digested those numbers by looking at the stock's reaction.
Oh, totally. I mean, pre-market shares rose a measured 0.74%. But once the regular session opened, the heavy hitters really stepped in.
Yeah, the stock closed at $13.82, up 1.77%. But the real story was the volume rate.
Absolutely. It surged to 10.8 times the daily average. I mean, that kind of multiple isn't generated by retail traders just clicking buy on an app.
No, definitely not.
That is massive calculated institutional accumulation. And that momentum actually carried right over into Tuesday, pushing the stock to close at 1410.
Wow.
Yeah, after carving out a brand new intraday 52-week high of 1487.
Okay, so the headline numbers and the stock reaction look stellar. But looking under the hood at how these specific operating segments are performing reveals this fascinating tug of war.
Yeah, tug of war between their core fee momentum and their actual reported GAAP profitability.
Right. The foundational metrics certainly show the platform is expanding. Total assets under management hit $96.72 billion, up 13% year over year.
And more importantly, for the cash flow profile, fee-paying AUM reached $78.11 billion, which is also up 13%.
Yeah, and when you break down those assets, the private market segment is totally dominating now, making up 69% of total AUM.
Heavily driven by direct-oriented co-investments, right? Which sit at like 55% of the portfolio.
Exactly. And when you look at the non-JAP metrics, the profitability on those assets looks incredible. Fee-related earnings, or FRE, grew 21% to $50.3 million.
And the FRE margin itself expanded to a massive 45%.
Right, which if you're evaluating an asset manager, seeing a 45% margin on fee-related earnings is essentially the holy grail of operating leverage.
Yeah, it proves their core infrastructure is fully built out.
But okay, I have to interrupt with a really pointed question here.
Go for it.
Because this is where we hit a massive contradiction. If fee-related earnings are up 21% and margins are expanding to 45%, why on earth did GAAP net income absolutely plummet by 38%?
Down to just $9.56 million, yeah.
Right, like how does that happen? That is a staggering drop in actual bottom line profit for a company that is simultaneously celebrating a blowout quarter.
Well, it looks alarming on the surface,
Yeah.
but it highlights exactly why you have to track the structural mechanics of how an alternative asset manager pays its people and its partners.
Okay, break that down for us.
So the GAAP margin contracted all the way down to just 7.1%. And that divergence comes down to two primary mechanical factors. First, you have higher localized compensation costs.
Meaning paying up for top-tier talent.
Exactly. When a firm is aggressively building out highly specialized verticals, like complex private credit, they have to poach talent from competitors.
Right, so heavy upfront cash or guaranteed bonuses.
Yeah, and all of that localized compensation hits your GAAP earnings immediately,
Mm.
long before those teams have generated their full potential on management fees.
So you're absorbing the cost of the talent today, but realizing the fee revenue tomorrow. That makes sense.
And the second factor management cited was a structural allocation of consolidated earnings directed toward non-controlling interests.
Right, so let's unpack that. Essentially, GCM Grosvenor, the public parent company, is sharing a much larger piece of the actual profit pie with minority stakeholders in specific underlying funds.
Yeah, which inherently drags down the net income attributable directly to the public shareholders. You're buying shares in the overarching management company, But you have to know how many slices of the underlying pie are promised to someone else.
Exactly. It's a critical distinction for you as an investor to understand. The cash generation is strong, but the distribution of that cash is highly complex.
It really is.
But looking at where that actual capital is flowing, we have to highlight the standout performer in the core business before we get to the big paper distortions. Credit was the single largest contributor to their Q2 fundraising.
Oh, yeah, pulling in over $900 million.
Right. And they successfully held the final close on an inaugural $1.2 billion credit secondaries fund.
Which is honestly a brilliant structural play. Institutional capital flooded into direct lending over the last decade, and now those investors desperately need liquidity.
But those primary credit loans are still locked up, right?
Exactly.
Yeah.
So GCN steps in with this massive dedicated fund to buy those locked up private credit portfolios at a discount, capturing the ongoing yield with a serious first mover advantage.
Right. A highly methodical, predictable expansion. But that brings us right to the fundamental tension we mentioned at the start of the deep dive.
The rocket on their balance sheet.
Yes. All of this steady, realized cash flow from credit is completely overshadowed by management's most dominant talking point. We have to talk about the massive SpaceX position.
The elephant in the room.
Oh, absolutely. GCM Grosvenor holds an early-stage investment in SpaceX with an original cost basis of $150 million. And today, that exact same position is valued on their books at approximately $3.5 billion.
Which is just a staggering outcome, like a 23 times multiple on invested capital.
It's wild. And that $3.5 billion valuation is split fairly evenly between their absolute return strategies and their broader private markets portfolios.
But the magnitude of that single markup completely skews the data for the entire firm.
Oh, it totally warps it. Look at the absolute return strategies composite. They reported a 14% gross return for the quarter with the SpaceX valuation included.
Right.
But if you strip SpaceX out of the math, the gross return drops to just 10%.
Yeah, and it directly impacts their forward guidance, too. That Q4 performance fee projection of $35 to $40 million,
Yeah.
management explicitly noted that the entire range assumes a baseline SpaceX private market price of $110 per share.
See, I have to push back on whether this is actually healthy for a publicly traded asset manager.
Well, so.
Well, it feels like counting your chickens before the rocket even launches.
Yeah.
Is having the largest single-issuer unrealized gain in the firm's entire history actually a good thing for a diversified asset manager?
Or does it create a dangerous distortion for retail investors trying to value the stock?
Exactly. Even CEO Michael Sachs seemed highly aware of this. He explicitly stated on the call, quote, "Nothing about SpaceX is typical."
Yeah, he's essentially holding up a giant neon sign warning analysts not to model the rest of their portfolio using this one astronomical outlier.
Because the distortion operates as a double-edged sword, right? On one hand, it's the ultimate validation of their sourcing capabilities. They found a paradigm-shifting asset early and generated billions in paper profits.
Which is invaluable for marketing and fundraising.
Sure. But on the other hand, it heavily masks the underlying steady-state operational performance. Private secondary market trades of a single tech company shouldn't dramatically swing the quarterly earnings of a $96 billion financial institution.
Right. And you could hear management actively trying to pivot the narrative away from the rocket ship and back to their bread and butter origination.
Yeah, they made a major point to emphasize that individual investor and insurance channels drove 23% and 18% of their year-to-date fundraising, respectively.
Despite representing less than 10% of their starting AUM, tapping into retail money is massive for long-term enterprise value.
But that SpaceX conversation perfectly segues into the notable risks here, and really the primary bear case we pulled from the source material, because paper gains look fantastic on a quarterly presentation.
But you simply cannot pay shareholder dividends with illiquid private stock.
Exactly. So let's break down the specific risks there.
Well, the SpaceX position is a purely unrealized mark-to-market paper valuation. It's subject to private market illiquidity and tightly bound by strict regulatory lockups. They can't just hit a sell button and convert $3.5 billion into cash tomorrow.
Right.
And management explicitly outlined that every $10 fluctuation in SpaceX's private share price alters GCM's net annual performance fee accrual by roughly $4 million.
Wait, so a $10 swing in the secondary market valuation of this one private company automatically wipes $4 million of future performance revenue right off the books.
Yep. The mathematical formulas governing their incentive fee agreements are highly sensitive.
That level of single asset sensitivity for a diversified platform is almost unheard of.
And you have to compound that single asset risk with the broader macro environment. The entire alternative asset industry is slogging through a deeply frozen market for mid-market exit transactions.
Yeah, the IPO and M&A markets are recovering at a glacial pace. Nobody is transacting. Buyers won't pay the high valuations and sellers won't accept discounts because debt financing is so expensive.
And that standoff is actively preventing GCM from monetizing $493 million in firm-level unrealized carry.
Right, which is essentially the firm's contractual cut of the investment profits. It's mathematically sitting there as a paper mark, but until the market thaws, they can't convert it to actual cash.
Exactly. And this disparity between highly predictable management fees and totally frozen performance fees has created a fascinating split decision among Wall Street analysts.
Oh, for sure. If you look at the consensus, the bulls are leaning entirely into the recurring revenue story. Piper Sandler and TD Cowen both raised their price targets on the stock to $16.
Maintaining overweight and buy ratings right.
Yeah. And Oppenheimer maintained an outperform rating with a $17 target. They see the 45% margin and the credit success and conclude the core engine is severely undervalued.
But then you have JP Morgan.
Right, the highly conservative outlier.
Wow. JP Morgan raised its target slightly from $12 to $13, but they explicitly maintained a neutral rating.
Which is crazy because the stock was already trading well over $14, so JP Morgan is effectively telling its clients that the stock is currently overvalued.
Because they hold a highly conservative outlook on exactly what we just discussed, the delayed timeline for private asset monetization.
Right. They refuse to value GCM Grosvenor based on the $3.5 billion paper mark of a single rocket company. And they aren't giving full credit for the trapped carry.
Their model dictates that until the exit environment actually thaws and these private companies are sold for hard currency, those paper marks are essentially theoretical.
So to quickly summarize this core tension for you. On one hand, GCM Grosvenor is successfully transforming its platform architecture to secure highly predictable, high-margin management fees.
Right.
But on the other hand, their actual bottom-line profitability remains totally clouded by the variable, unpredictable nature of massive realization-driven paper assets.
Which leaves you with a really provocative thought to mull over. As alternative asset managers aggressively shift into longer-duration private markets and hold massive concentrated positions in single unicorns like SpaceX, does the traditional definition of diversified fee income need to be completely rewritten for retail investors? When you buy shares in a publicly traded asset manager today, are you actually buying a diversified stream of predictable fees, or are you unwittingly buying a shadow venture capital fund?
Oh, wow. Tethered entirely to the explosive fate of a single rocket company?
Okay.
That is a great question for you to explore on your own.
It really fundamentally changes the risk profile.
It totally does. Well, that wraps up today's deep dive into GCM Grosvenor's earnings. Be sure to follow the show for your daily, no-nonsense coverage of the earnings reports that actually matter.
See you next time.